With an improved job report, the Fed has indicated the beginning of the end of its bond buyback program, maybe as soon as this month. Will the subsequent move in interest rates be slow or rapid? How will that affect your portfolio? And what can you do about it? Good morning, my name is Paul Carroll. I'm the CEO and founder of Efficient Wealth Management, a boutique wealth management firm based here in the Woodlands, Texas. The Great Recession of 2007 and 2008 resulted in Helicopter Ben Bernanke, pursuing a bond buyback program that was designed essentially to print money. This bond buyback program drove interest rates down to historic low levels. Globally, the program's been considered a success. Despite all the hangover we have today, it is easy to forget two core things. One, in 1929, when that market collapsed, they did the exact opposite. They reduced spending, they reduced taxes, they embarked on a program of extreme austerity, not unlike what happened in Greece, Spain, and some other countries this time, and they got exactly the same result. However, what was learned in the Nordic countries in the late 1990s is when you have a bank finance-led recession, the best way to keep it from morphing into a depression, much like what happened in Greece, is to print money. Print it as fast as you can. The problem is, once things are back to normal, even though there's one heck of a hangover, is you have to unwind the program. You have to slow it down. And can you? Can it be done? Yes, it's been done. How do you do it? You slowly stop the buyback program and you target a 2 to 3% inflation rate. That enables over a 20-year period the debt to be cut in half through inflation, and through the growth of tax revenues and the normal organic growth of the economy, you get to pay the bill for what could have been a really bad depression. It's a deal with the devil, and one will argue about it indefinitely. But this is over, and how is it going to affect the economy? How is it going to affect short-term and long-term interest rates? As the bond buyback program slowly is unwound, short-term and long-term interest rates will go up. How much and how fast? Who knows? The markets actually predict it won't be too rapid an increase, and it won't be too radical. Markets usually are the best bet there are, but they don't always get it right. What happens if it goes up rapidly? Bonds are going to get hurt. Long bonds are going to get hurt badly and quickly. Non-traditional dividend income investments are going to get hurt badly. Master limited partnerships could take a hit. Leveraged closed-end bond funds would be hurt very badly. If it's a more gradual increase in interest rates, the same is true, but in a more gradual fashion, more tolerable level of pain. Which is better? It's really hard to say. As long as it doesn't shock the economy out of its slow growth mode that it's in now, you could argue that a slightly more rapid interest rate increase would be more advantageous, simply because finally the bonds will be a viable alternative to equities. It will certainly result in a beginning of the end of this wonderful stock rally we've seen for the last 2 to 3 years. Obviously, that can't go on forever either. Are stocks overvalued? Probably not overvalued, but clearly they're fully valued. So the party's definitely coming to an end. It's not a foregone conclusion that stocks will drop sharply. More likely we'll see a more subdued deceleration. Certainly there are no imbalances in the economy of the nature of the 2006-2007 mortgage overhang that threatens to totally unravel the economy into depression. This is more of a hangover economy where things are very likely to struggle going forward in terms of investments. Caution with non-traditional high-yield investments. Caution with long bonds. Expect very little from gold because it's not likely that inflation's coming back with a vengeance. It is always possible. But we live in a very different world than we did in the 70s, where the global bond markets are extraordinarily punishing of long-term inflation. Far more likely is if inflation starts rearing its head beyond 3%, interest rates will be spiked to get it back under control. When the tide goes out, there's a saying, we get to find out who's naked. The Oracle of Omaha, Warren Buffett's favorite saying. And this is certainly going to happen for those investors who are in the non-traditional high-yield products. I'd be happy to talk about this further. You're welcome to call me, 281-528-1200. But otherwise, I wish you the best of investment success.